with COVID-19, obviously there's been a tremendous amount of flux in the market and a little bit of a roller coaster ride on that end, but talk about what you're seeing now and then what your encouragement would be to your clients or prospective clients. So give us a little bit of the tale of the two coins there.
So you're exactly right. The market has been very wild with coronavirus. The market hit the high in February. On the 19th, the S&P did, and then it went down 34% in about 33 days. And so it was a very wild ride, probably the quickest downturn and the quickest, deepest downturn that I think we've seen in the history of the market. And so, but since then, the market's up about 45%. Still down a little bit from the top, but it's been an interesting. It's really, I would say, an interesting case study for emotions, because we have seen, literally, Brian and I came into the office one day and we said, I think today everybody hit the wall. There was this breaking point that happened during that downturn. I don't remember exactly the day, but there was so much emotion. There was fear tied up into it, because there's a good bit of fear and emotion tied up when it comes to money. And so, we have seen that shift, obviously, with the market doing well. I had a conversation with someone over the weekend. They said, I don't quite understand why the market's doing what it's doing with coronavirus and political environment and all that different stuff. But it has rebounded very well. And so, but there's still a lot of uncertainty. And that's the thing. The markets hate uncertainty. And so, so part of our responsibility and part of what we love doing is helping people with proper expectations, helping people really understand what's going on, why the markets are doing what they're doing, but having great intentionality with the plans and helping them develop those plans, which really helps combat some of that fear that folks are feeling.
Talk about, on your end, when you take a long-term, and obviously everyone's a little different, and part of that goes back to the questions of, long-term, short-term, high growth, low risk. Talk about some of those variables in terms of matching expectations, and then trying to make sure that when you look at the coronavirus, and like you said, the markets don't like uncertainty, and yet we live in a world with uncertainty. And so managing all these different expectations to match up, to kind of fit the story, as you said, is a really important part of what you're doing. So talk about kind of that role of matching expectations and understanding the bigger picture of this.
That's a really good question, Jeremy, because I think everyone has their own preconceptions, right, of aggressive versus conservative. That means different things to different people. And we can fall in that trap pretty easily of saying this is aggressive. Oh, you know what that means, but no, that can be really different, So, it is really important for us. There are kind of two main things that we always want to speak to. It's that risk and understanding what level of fluctuation or it can be true risk of potential loss of real loss versus fluctuation in value. So unpacking what an aggressive portfolio means versus a conservative portfolio, meaning that, you could decline this much if 2008 were to happen tomorrow, or, you should grow, roughly this amount, year over year over, you said long-term. What is long-term? A financial planner is generally going to say 10 years or more, but that if you're closing down retirement, the long term is now. Right. So, we need to tie, and we need to help unpack that expectation, that understanding of what those words mean. But then we also need to tie it to the actual goal, because someone might be looking for a conservative investment, but they might need to be a little bit more aggressive, or they might think that they want to be aggressive until February and March happens. And then they realize that that's not as much fun as it used to be. And they might not need to be that aggressive, right? And if you don't need to, at some point you might say, we don't want to. So we have to tie the need to the expectation and the want. And generally that means, again, typically retirement planning, those things mean cash flow. So tying the need of, we need to be this aggressive to generate this much cash flow, but also making sure that you're comfortable with the amount of volatility that that brings in the accounts. So I think that's the main thing that we help unpack, and it can be pretty complex.
Well, just like you said, you know, aggressive means one thing to you and another to me. And it's also another thing when you start seeing the dollar, but understanding that it's value, not necessarily dollar. So I think all of that goes back to trust and relationships, which are really paramount, obviously, for what you do.